Welcome to a new IFRS Educational Fund series. It is an initiative of OJ Inspiration Limited. It is dedicated to providing complementary and supplementary education on International Financial Reporting Standards, IFRS, through a multiple choice question and answer approach. It is intended to make learning or intellectual assurance fun. In this session, we shall be considering 10 questions of set 1 to which the answers have been provided on IFRS 15. This is the standard on revenue from contracts with customers. Viewers and subscribers have 30 seconds to select or choose their answer to each question. The answers to the 10 questions are reviewed at the end of all the questions. Please enjoy it. Question number 1. IFRS 15 replaced which of the following standards? A. IAS 17, B. IAS 18, C. IAS 11, D. A and C, E. B and C. Time counts. Ten seconds done. 20 seconds gone. Timer. Question number 2. Increases in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases in liability that result in an increase in equity other than those relating to contributions from equity participants is called A. Income, B. Revenue, C. Gains, D. Surpluses, E. Net inflows. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 3. The amount of consideration to which an entity expects to be entitled in exchange of transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties, is called A. Contract asset, B. Transaction price, C. Standalone selling price, D. Revenue, E. Performance rights. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 4. The core principle of IFRS 15 is that an entity recognizes revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services via A. One-step consideration, B. Two-step consideration, C. Three-step consideration, D. Four-step consideration, E. Five-step consideration. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 5. Which of the following does not hold about performance obligations? A. Performance obligation must be satisfied at a point in time. B. Performance obligations may be satisfied at a point in time. C. Performance obligations may be satisfied over time. D. Performance obligations may be measured using input methods. E. Performance obligations may be measured using output methods. Time counts. 10 seconds gone. 20 seconds gone. Timer. Question number 6. An entity's right to consideration in exchange for goods or services that the entity has transferred to a customer when that right is conditioned on something other than the passage of time is called A. Income, B. Revenue, C. Contract asset, D. Receivable, E. Transaction price. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 7. An entity's unconditional right to consideration is called A. Income, B. Revenue, C. Contract asset, D. Receivable, E. Transaction price. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 8. When any party to a contract has performed, an entity presents a contract as a contract asset or contract liability in the statement of financial position, depending on the relationship between the A. Entity's performance and the transaction price. B. Entity's performance and the customer's payment. C. Entity's performance and the revenue. D. Transaction price and the revenue. E. Transaction price and the receivable. Time counts. 10 seconds gone. 20 seconds gone. Timer. Question number 9. The incremental cost of obtaining a contract with a customer which the entity expects to recover are A. Written off to retained earnings. B. Written off contract assets. C. Expensed when incurred. D. Amortized on a systematic basis. E. Adjusted off contract liability. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 10. Costs that relate to satisfied performance obligations in contract are A. Expensed, B. Recognized as asset, C. Added to contract asset, D. Deducted from contract liability, E. Adjusted to retained earnings as a retrospective restatement. Time counts. 10 seconds gone. 20 seconds gone. Timer. We proceed to review the answers. Question number 1. The answer to question number 1 is E, B, and C. IFRS 15 revenue from contract with customers replace IAS 11 construction contracts and IAS 18 revenue. It also supersedes associated interpretations on these earlier standards like SIC 13, revenue, data transactions involving advertising services, IFRIC 13, Customer Loyalty Programs. IFRIC 15, Agreement for the Construction of Real Estate. And IFRIC 18, Transfers of Assets from Customers. E is the answer to question number 1. Question number 2. The answer to question number 2 is A, income. IFRS 15 defines income as increases in economic benefits during the accounting period in the form of inflows or enhancement of assets or decreases of liabilities that result in an increase in equity other than those relating to contributions from equity participants. Revenue is an aspect of income, and it is defined as income arising in the course of an entity's ordinary activities. A is the answer to question number 2. Question number 3. The answer to question number 3 is B, transaction price. Transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties. Revenue is the portion of transaction price recognized for a period when certain criteria or conditions are met. B is the answer to question number 3. Question number 4. The answer to question number 4 is E, 5-step consideration. IFRS 15's core principle is that an entity recognizes revenue to depict the transfer of goods or promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for the goods or services by applying 5 steps. The first step consideration are: 1, identify the contract or contracts with a customer. 2, identify the performance obligations in the contract. 3, determine the transaction price. 4, allocate the transaction price to the performance obligations in the contract. And 5, recognize revenue when or as the entity satisfies a performance obligations. E is the answer to question number 4. Question number 5. The answer to question number 5 is A, performance obligations must be satisfied at a point in time. The position in option A is incorrect because performance obligations may be satisfied at a point in time, and as well may be satisfied over time. IFRS 15 recognizes that performance obligations may be satisfied at a point in time or over time. The positions from options B to E are correct and thus hold with respect to performance obligations. A is the answer to question number 5. Question number 6. The answer to question number 6 is C, contract asset. Contract asset is an entity's right to consideration in exchange for goods or services that the entity has transferred to a customer when that trust is conditioned on something other than the passage of time. C is the answer to question number 6. Question number 7. The answer to question number 7 is D, receivable. A receivable is an entity's right to consideration that is unconditional. A right to consideration is unconditional if only passage of time is required before payment of that consideration is due. D is the answer to question number 7. Question number 8. The answer to question number 8 is B, entity's performance and the customer's payment. When either party to a contract has performed, an entity presents the contract in the statement of financial position as a contract asset or a contract liability, depending on the relationship between the entity's performance and the customer's payment. B is the answer to question number 8. Question number 9. The answer to question number 9 is D, amortized on a systematic basis. Incremental costs of obtaining a contract with the customer which the entity expects to recover are recognized as an asset. This asset is amortized on a systematic basis that is consistent with the transfer to the customer of the goods or services to which the asset relates. D is the answer to question number 9. Question number 10. The answer to question number 10 is A, expense. Costs that relate to satisfied performance obligations or partially satisfied performance obligations in the contract are expensed. These are costs that relate to past performance. A is the answer to question number 10. That is all for this set. Thank you for joining us for the set 1 of IFRS 15, Revenue from Contracts with Customers. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +2349 030 770109. All rights to this production and others in the service are reserved for OJ Inspiration Limited. Thank you once again, and bye for now.